Today, we are cracking open a 500-year-old secret. It's a system so powerful, it's been the invisible engine behind pretty much every successful business you can think of, from Renaissance traders to modern tech giants. It's called double-entry accounting, and it is the reason companies don't just lose track of their money.
I mean, really think about that. How does a massive global company, or even just your local coffee shop, keep track of every single penny coming in and going out? The answer isn't some fancy, complicated new software. Nope. It's a timeless principle of perfect balance.
And this is it, right here. The core idea is brilliantly simple. For every action, there is an equal and opposite reaction. Every time money moves, it gets recorded in at least two places. It sounds basic, I know, but the power of this idea to guarantee accuracy is, well, it's pure genius.
Okay, so here's how we're going to break this all down. We're going to start with the fundamental concept, what I call the balancing act. Then we'll dive into the business diary, which is where every transaction gets its start. After that, we'll see how everything gets organized in the sorting it out phase. Then comes the moment of truth, the final check. And finally, we'll see why all this matters when we turn these records into reports.
All right, first up, the business diary. This is the absolute starting point for every single financial event in a company's life. Its official name is the journal, and you can really think of it as the day-by-day story of a company's money. So, anytime cash is spent, or a sale is made, or a loan is taken out, the very first place it gets written down is right here in the journal. It's a chronological log. It captures the who, what, and when of every transaction in the exact order that it happened, no exceptions.
Now, to make this work, we use two columns. Debit on the left, credit on the right. And listen, you need to forget everything you think you know about debit and credit from your bank account. In the world of accounting, they're just fancy words for left side and right side. That's it. And the one golden rule you have to remember is this: the left side must always equal the right side, period. So you're probably asking, okay, how do we know what goes on the left and what goes on the right? Well, it all comes down to these three simple golden rules. For personal accounts, meaning people or other businesses, you debit the receiver and credit the giver. Simple enough. For real accounts, that's stuff you can touch, like cash or equipment, you debit what comes in and credit what goes out. And finally, for nominal accounts, which are things like income and expenses, you debit all your expenses and you credit all your income. That's it. Every transaction in the world fits into one of these rules.
Let's make this real. Our coffee shop buys a new espresso machine for $20,000. So let's ask the questions. What came into the business? The machine. That's a real asset, so we debit what comes in, what went out. The cash. Also a real asset, so we credit what goes out. And there you have it. $20,000 on the left, $20,000 on the right. The scale is perfectly balanced.
So a diary is great for telling a story day by day. But it's not super helpful if you just want to know, say, how much cash you have left. For that, we need to get organized. And that brings us to our next step, moving from the diary to the filing cabinet, which we call the ledger. The ledger is basically the master filing system. Think about it. The journal is one long, continuous book. The ledger, on the other hand, has a separate folder, or account, for every single thing. There's a folder for cash, a folder for machinery, a folder for sales. You get the idea. So here's the best way to think about the difference. The journal tells you the story of your business, day by day. The ledger gives you the complete history and the current total for any one thing at a glance. It's like the difference between reading a diary from start to finish versus looking up a specific topic in an encyclopedia. And the process of actually moving all these little entries from our journal's diary into the ledger's organized files, that's called posting. We're literally taking each line item from our story and filing it away in the correct folder, one by one. And this shows you exactly what happens to our espresso machine purchase. The $20,000 debit to machinery from our journal, it gets posted on the debit or left side of the machinery account. And the $20,000 credit to cash, that gets posted on the credit or right side of the cash account. See? One entry in the diary becomes two neatly filed entries in our ledger. Okay, so we've recorded everything in order. We've sorted it all into neat little piles. But with all this copying and pasting, how can we be absolutely sure we didn't make a simple typo somewhere? Well, it's time for the moment of truth. This is called the trial balance, and it's our ultimate safety check. What we do is we take every single account from our ledger, we add up all the debits and credits to get a final balance, and then we list all the debit balances in one column and all the credit balances in another.
Now, the whole point of this is, first, to do a quick math check. If those two columns don't add up to the same number, we know, without a doubt, there's a mistake somewhere. But second, and this is so important, this simple summary gives us all the clean, verified data we need for the most important step of all. Here's what that looks like. We've gone through our ledger and figured out the final balance for every account. You can see things like cash and bank have debit balances, so they go in the left column. Things like capital and sales have credit balances, so they go on the right. We do this for every single account in the business. And now for the test. We add up every single number in that debit column, all the assets, all the expenses, and we get our grand total. In this case, it's $21,390.
And here's the magic. When we add up that entire credit column, all the money we owe, the owner's investment, all the income, boom. We get the exact same number, 21,390. Our books are balanced, the system works, it's a beautiful thing.
So, journal, ledger, trial balance. I know, it might seem like a lot of steps. But why do we go through all this trouble? Because this perfectly balanced data is the raw material for something way, way more powerful.
See, this was never just about tidy bookkeeping. The entire point of this whole process is to build the foundation of data that is so solid, so reliable, that you can use it to see the absolute truth about a company's financial situation.
And this right here is the ultimate payoff. From that one simple, balanced trial balance, a business can create the two most important financial reports that exist. First, the profit and loss statement, which tells you the bottom line. Are you actually making money? And second, the balance sheet, which gives you a perfect snapshot of your company's health, what you own versus what you owe, on any day you choose.
So when you boil it all down, it's this simple. Every single transaction has two sides. A few easy rules make sure that the debits always equal the credits, and the trial balance is the final proof that the entire system is accurate, which then lets you get true insight into your business.
This 500-year-old system is designed to tell a story that is perfectly balanced, perfectly logical, which leaves us with one last, pretty important question. If a company's books tell a story and that story doesn't balance, does it just mean there's a typo, or does it mean something else entirely?